Hey, everybody. This is Eric Hale with Trader Oasis, and I'm joined by Greg Jensen from Options Animal.
Morning, sir. Good to be.
Yeah, good to be here. We just want to get together real quick and touch base with you all this week and talk about a few things that are happening. Personally, well, not personally, but Greg and I are getting on a plane tomorrow, not the same plane, but we're going to meet at the same place. By the way, we need to coordinate that if we're getting in around the same time. But we're going to an economic conference, a very small economic conference. And we're fortunate enough to have been invited to dinner with a couple of Fed presidents. So some of the stuff we're going to talk about today, we have questions, and we'll probably have answers for you to share next week, because we'll be able to have some one-on-one conversations with several key members of the Federal Reserve.
Hopefully we can give them to you and not have to speak in Fed speak, but we may.
Well, here's the thing is, they're all people, and they put their pants on the same way everybody else does. I mean, they're just, they're really realistic people. And I don't know, people listening to some of the rhetoric you see in social media and people talking about, oh, the Fed and these like big evil people. They're really good people trying to do good things, and they're very smart people.
They do have horns, though. I've seen them.
Horns?
Horns, yeah. You're right. There's some crazy stuff out there.
Actually, they probably, burn fires at night and worship some Moloch the owl or something like that. I don't know. Have you ever seen that stuff about the something Grove that's in California?
Yeah.
There's some interesting stuff. Is it Moloch the owl? Anyways, we're getting a little bit off track. I don't think the FOMC, wears dark robes and worships owls. I think they try to do their best to help us by controlling their mandate, which is moderate inflation with maximum employment. So we'll have some insight later to share with people, but we wanted to touch base and just talk about a few things that are going on right now. Some interesting stuff in the AI space going on with Google and Microsoft. Also, we have the jobs report from last week. I think we've had a chance to digest that and look into it. And then also last night was President Biden's State of the Union speech. So just a couple of highlights from that. Does that cover everything, Greg? Or
yeah, I was going to say that's probably where we ought to start, is the President's State of the Union address. I mean, after watching it and reading the transcript afterwards, not a lot of unexpected comments to me that came out of the State of the Union. I know there was some speculation on Twitter yesterday's. That's why we had some of the whipsaw action we got yesterday after, Fed Chair Powell's speech, that something was being priced into the market that was going to come out of the State of the Union address. But it was just the same old stuff. Now, that's not to say that we shouldn't talk about some of them. I think probably the most important topic was probably that of the debt ceiling, and that, President Biden urged all of Congress that we need to make sure that the United States pays its bills and is able to service the debt that we have, and that we raise the debt ceiling. And I know that that's some speculation out there that maybe they will, maybe they won't. I think most of the people out there telling you that they're not going to are some type of extreme pessimism, one way or the other, more political than anything. And I think it's a tool right now that's probably going to be used politically to bargain one way or the other. I know, Eric, you had a couple of charts you wanted to bring up, or at least a chart you showed me that you wanted to share with everybody about the debt ceiling.
Sure. So there was some language thrown around and some very key words. So Biden asked Congress to, quote, commit here tonight that the full faith and credit of the U.S. will never be questioned. And those are some very specific words that have some specific context that really goes to the reserve currency, the U.S. dollar, and our debt rating as well. So there's some interesting stuff in that space. And so the debt ceiling is something that we've mentioned previously. It's really a tool that is designed to be changed. It's designed for us to have a limit, but it's always increased. And I think there's something like 160 times in history that it's gone up. And this chart from Macro Bond shows the the statutory limit, the so-called debt ceiling, and how we've progressed over the years. And I think if you look at this graph, you would say there's no question we're going to raise the debt ceiling. The question is, how much drama are we going to have? And I think there's going to be a game of chicken that's going to happen between the Republicans and the Democrats, and the Republicans are going to use it to drive through as much policy change as they can, threatening a stalemate. Now, we've seen, if you look at this chart, you look at there's places where we've had these little wiggly lines and gone through. The big one, it doesn't look particularly noteworthy, but this was the big one in 2011, where we hit the debt ceiling limit, and that one caused a lot of drama. And that's when Standard & Poor's downgraded the U.S. debt from AAA to AA, and they still haven't increased our debt quality rating. So I think that's a little bit of I don't know, showmanship and theater. But here we are today, where we are right at the debt ceiling, and the question is, what are we going to do to get through this, and when's it going to happen? And trying to pin the tail on the donkey, it's like the same game of how many Fed increases are we going to have? Nobody knows. It's a guess. But this should be on everybody's radar. I'm sure it is. People watching this are not surprised by this. I think the good news is we're going to get through it. I think any pullback that we have, I don't think either party is willing to risk the full faith and credit of the United States, because they understand the absolutely massive consequences that could have. And I think the big issue is changing the reserve currency, the US dollar, to something else. And by the way, there are other parties out there that very much would like for that to happen, to get away from the petrodollar or the US dollar being the reserve currency of the US. And certainly China and India and Russia would love to see that change. So I don't think we'd get, like I said, it's going to be a game of chicken to see what happens here. I think there's a very good chance we're going to see some pullbacks in the market, some volatility that could happen as the drama ensues. I think that will probably spell an opportunity for people to maybe take some, if we get pullback, I'd probably be looking for it to, all other things being equal, maybe an opportunity to get long.
Yeah, I think the key thing you said there was all other things being equal, right? Make sure that's what's causing the pullback, and not something else. Because yeah, if inflation is in the trajectory that we think it is to the downside, and improving, if the economy is still showing that GDP is solid, we're growing, if employment stays stable, and we don't hit the hard landing scenario that some people are worried about, if we can get a soft landing, but then the market drops because of the debt ceiling issue, that's, I think, the opportunity you're talking about. It's probably just going to be an opportunity to get long in the market. Make sure that those other things aren't happening at the same time too, because if we have a debt ceiling issue and then all of a sudden we get some really hot inflation number and the Fed says, hey, we're going to have to stomp on the brake again, that's a different story that may cause some of the bearish trend. So just keep your eyes open to everything. I guess that's one of the other, not to jump forward yet to the employment report, but that's one of the things that you insinuated you and I are going to be able to get maybe some clarity from a couple of Fed governors, or I guess it's one Fed governor and one Fed president, right? It's Harker and Waller, who we're going to see this coming weekend. And the question that hopefully we get some clarity on is, what is their stance on inflation and versus employment? Because, you had mentioned before we started recording, a lot of the market, and I agree with this, is worried that the Fed has to see employment worse than we're at right now, that we need a decrease in the employment market for them to be happy and finally stop raising rates. And I hope that's not the case, but maybe it is. Maybe we'll get some clarity there. I don't necessarily think it is. I know you're on the same page with me there, that I think the Fed would love to see the job market stay resilient and strong and have inflation come down naturally. Whether that's a Goldilocks hope or not, maybe that can happen, maybe it can't. But hopefully we get a little bit of insight there this weekend.
Yeah. So going back to, I mean, that we had this conversation with Waller and Jackson Hole at the Rocky Mountain Economic Summit this summer, and I heard Waller say that don't be surprised if you see unemployment go to 5.5%. So I think they'll be pleasantly happy to see that we're at all-time lows in unemployment, and I don't think that they need to see unemployment get bad. But I think his comments were, don't be surprised. When it comes to inflation, though, I think one of the biggest concerns about the components of inflation is the services side. And so with such a strong labor market, if we're seeing inflation in wages, that leading to, or at least, total compensation ended up translation or spilling over into more expensive services, and then we see inflation go up there. So if you get micro or get down into the weeds and the components of inflation, that's where labor matters. And like I said, I think the Fed would love to see a strong labor market with disinflation happening, with inflation coming back down. And do we need to have pain in the labor market for that to happen? I don't know. And I think there's another side of this, and you touched on a little bit, and that is the jobs report from Friday. We've had the opportunity to dig into that a little bit deeper and get some insight into why it was such a big surprise. It really caught everybody off guard. And I think a big part of it, we had super, super strong non-farm 517,000 jobs added, and an unemployment rate that's the lowest we've had since 1969. But a good portion of that was due to some quirks that happened in January. One in particular is we had unseasonably warm weather, and so that helps with employment. The other was the resolution of some major. It's actually estimated that weather added 126,000 jobs. We also saw a strike of I think it was a teacher strike, where 35,000 people came back into the workforce. And then finally, there's some weird seasonal factors. When you look at some of these economic numbers, there's these seasonally adjusted numbers. And so without getting mired in the details of that, there's some of the boost was due to this seasonal adjustment thing. So I was reading.
You forgot one.
What's that?
There was also a State of the Union address that someone needed to have a really good jobs report so that he could pound the table about the really strong jobs market. That doesn't happen, does it?
Does it? I don't know. Maybe, but certainly didn't hurt the president there. But I don't think we're going to see as strong of a report in February. And I think the Fed is probably realizing that this jobs report, yes, it's strong, but they're not idiots either. By the way, there's also going to be 2 vice presidents of research that are going to be at this conference as well. They're basically the number 2 people at each one of the Feds. So those people will definitely have some insight, and they're plowing into. I'm blown away by the number of PhD economists that work for the Fed. So I'm sure they have lots of people thinking about a lot of this stuff. And we'll get some insight into how that employment really does spill over to what the Fed is trying to accomplish. I don't think my gut is that they're going to say, we're not trying to hurt employment. We just want to see inflation come down. And it's that services thing that's probably the big concern there.
Well, and that's essentially what Powell said yesterday. I mean, he said that, we're seeing the goods sector, that disinflation has started, and we're seeing the housing sector roll over, at least right now, so that we'll start to see the disinflation come from housing. And as long as those two continue that trend, the other ones are going to be stickier. That services sector is going to take a while. And he threw out up to 2 years before we may see it back to normal levels yesterday. Yet the market, again, yesterday was very optimistic, and the only word they heard was disinflation. And so we rallied on the news. Today we're giving a little bit of it back, but I agree that it's going to be a longer battle with inflation because of that sticky services sector. We'll see how much longer it takes. One other headline I wanted to touch on today before we wrap it up, is this battle that's brewing in AI, artificial intelligence, specifically between our two big tech powerhouses. It's kind of funny. These two have gone back and forth in the history of technology as which one of them is the evil empire, right? Back in the 90s, Microsoft was the evil empire. They were Darth Vader. And, sometime, maybe last century, Google, I think, took that title away from them. And I think Microsoft is starting to maybe claim it back as we roll into this era of artificial intelligence, as it looks like Microsoft's partnership essentially with ChatGPT seems to be being rewarded a little bit more by the market than Google seemingly trying to play catch up with their own version of AI that they're rolling out. As Google's getting whacked today, down $8, down 7.5%, back actually under $100 a share as I'm talking right now. I don't know. Do you have an opinion on which of these two is winning the battle, or does it matter? Are they both going to be able to participate in this new venture of AI?
Well, I think one thing for sure is AI is going to change everything. I think you and I are probably going to lose our jobs because we'll be by an algorithm. The stuff that's being done is absolutely amazing. I'm not exactly sure there. So these sort of moves like this, they're usually big sentiment driven moves. And there's, we get a lot of volatility that happens in the market. Sometimes it's not always a long-term reflection of a change in value, and that maybe this is, sometimes there's other factors that could be just causing volatility. We get algos that are out there, and the options market can move things as well too. I don't know for sure. I don't think this is a step change in Google. My guess is Google's probably way ahead of us, or way ahead of anything that's already been announced. So I don't know. I don't trade Google or Microsoft, but I think either one of them. I mean, they're both good companies. But yeah, it's been interesting to see that it's been a tale of two different stories there.
I trade them both, and honestly, I think this is an opportunity with Google. I agree with what you said there. I think the market's being overly harsh to Google right now. Now, that doesn't mean the market can't be irrational and push it even lower. It may. But long term, I think this creates an opportunity to get long Google. As like I say, I think the market's overreacting because we're still in the really early stages of the internet, of artificial intelligence. I was going to say, this reminds me of the internet launch, back in the early to mid 90s, and who was going to be the player at that time. Was it going to be AOL? Was it going to be Microsoft? Was it going to be Dell Computer? There were a lot of big names at the time. I don't think anyone realized at the time how big Amazon would end up coming out of that. And if they were arguably the biggest winner out of the internet bubble launch that happened at the time. I think now it's hard to say that Google or Microsoft are even going to end up being relevant 10 years from now in the artificial intelligence space. Maybe they are, maybe they aren't. But I think from Google's business model, the fact that they're selling the stock off today really has nothing to do with the fundamentals of Google and how much money they actually make. So for me, this is, I think, a short-term opportunity.
Yeah, it looks like the overall indices are starting to come back. And the other equity that we talk about sometimes is Tesla breaking above 200 today, which is currently 247, was seen as a critical level of resistance here. So interesting stuff going on, some exciting stuff. There's Investors Day. You and I kicked around the idea of going to Investors Day. It's not going to work out for me for personal reasons, but March 1st in Austin, and there's been some announcements that there's the master plan that Elon Musk has. So part due was released, I think, 6 years ago. So there was the original master plan, which is 10 or 12 years ago. Then there was a part due, and so the third part is going to be released on May 1st. So it's interesting if you go back and read those when he wrote those master plans. You're like, yeah, sure, crazy, but he's done everything. So it'll be interesting to see how that's playing out. And it's certainly catching some, although it looks like the stock may be running out of steam here. I would expect some sort of level of resistance here.
Hey, by the way, I'm going to end with the tweet of the day.
What's that?
It's from Macro Alf, at Macro Alf, if you don't follow him. Fed's Kashkari, quote, "There is a large tray of lasagna that I used to buy that used to cost around $16. Now it's around $21. That's my own little measuring stick of how inflation is going," unquote. This guy votes on the FOMC monetary policy in 2023. Solid analysis here.
Neil Kashkari is no idiot. Yeah, I think did he work for, it's either BlackRock or Goldman? He worked for one of those two.
I think it was BlackRock. I think
I'll be honest with you. If I could bet on a person, I would invest in him. I would put my money on him. I think he's got a great future. So I don't know where he's young. He's got a lot going on. Minneapolis Fed. I like him a lot. Although I'd like to meet him someday. Oh, maybe he'll be at the Rocky Mountain Summit this summer. So
yeah.
Well, fun.
All right.
To get together. Hey, stay tuned for next week. It's going to be pretty exciting. Greg and I are going to share what we can. Some of the meeting will probably be Chatham House rules, so we can't share everything, but certainly whatever we can, and we can give you our thoughts and opinions on stuff. And I'll be honest with you, I don't know if you've been paying attention to us for a while. Greg and I were talking about this. We've been early and right about what the Fed is, and it's taken a while it's taken a long time for the market to come around and realize that the Fed was really serious about what it's doing and cutting rates. And we've been sharing that information for months with people. So we'll probably come back with some information that's early, but probably going to be right as well. And so we'll talk to you about how we get that, but we'll share what we learn, and look forward to seeing you all next week.
Thanks, everybody. Don't forget, like and subscribe. Peace out.
Peace out.